Hello, everyone, and thank you for joining us today for this webinar. Today, we're going to talk about opportunities in emerging markets, and more specifically, we're going to talk about India as a market for long-term investing. For that reason, we invited a wonderful speaker tonight. So with us, we have Gaurav Sharma, who is portfolio manager at ASK Capital Management. And also with us today is Vivek Mohindra, who is one of our co-founders and responsible officer at Kristal.AI. As always, please use the Q&A tool to ask questions anytime. If you have any remaining questions, please reach out to your relationship manager or simply send an email to support@Kristal.AI. Finally, this webinar is being recorded just in case you want to revise any details or share it with your friends. So without further ado, I want to hand it over now to Vivek, who is going to start this presentation. Thank you.
So what I'm going to do is actually, obviously, Kristal.AI is a platform, so we like to showcase well-known and performing fund managers such as yourselves, and we use a platform in order to do that. So what I'm going to do to start with is just kind of share our screen. So this is what this is basically our website. So people can actually go and have a look at your fund on your website. You don't even actually have to log in. You can just go, you can go into products, and you can go into look at funds, and we have obviously got your particular fund on our platform. You can look at it without logging in, and this is the fund and some of the details about it and so on and so forth, the strategy. I have also logged in and looked at it. So this, after you log in, you get to see a little bit more details. How it's been performing, etc. Some of the documents relating to the fund itself on platform. How has it been going over the last few years? And you can do some kind of analysis on it. You can also have a look at the documents respectively, like the latest fact sheet. There's the 30th June fact sheet, so you can kind of open that up if you want, and that will give you a very nice commentary from you guys about India. But like I said, so obviously, we are interested in multiple countries, multiple geographies. One of our intention is to kind of diversify exposure for all our clients. One of the things which people will see when they come onto this platform is the details, is because, we've only got it from the returns from 6 July 2017. The fund has been there for a much longer time and has had a very good performance before that. But this particular fund, which is on our platform, which is an international fund, has a history from 6 July 2017, and we get the data from Bloomberg, not necessarily from the fund manager. That's where we take most of our data from, and it's showing a negative return. So perhaps you can cover that, and the history of your fund. Most people haven't really made money in India. That's what mostly investors say, that the market has been trading sideways. But yours is one of the funds that has kind of had a good track record over the last 10 odd years, 8, 9, 20 odd years, and I'd like you to cover that so that you can explain why this negative thing is, and then you're still on our platform, and one of the good performers. And then so I'll let you start that, and I have a few questions also, and then we'll take some questions from the participants also. So I'm going to pass it back to you. I'm stopping my share. Back to you.
So is this visible now?
Yeah, I guess. Yeah, I can see your slides. Yes.
Great. Thanks, Vivek, for that. So as you've said, that we have a long track record of generating market-beating returns in India. Focused on India, long only India equities managers. The current fund that you see was launched in
Maybe you want to speak a little louder. I
Sure.
don't know if everybody, just let me know.
Yeah. So the current fund in Singapore, which is a Singapore domiciled structure, was launched in 2017 July, as you showed on your website. But the strategy itself has been around since Jan of 2010, when it was launched in a PMS format in India, as well as a Mauritius fund in US dollar terms for international clients. So it's been 5-star rated by the Morningstar, and this is for the Mauritius fund. What we do is, the way we kind of invest is, the philosophy is preservation of capital, followed by growth of capital over a period of time. And we try and do that by creating a portfolio of companies, very concentrated, 20 odd stocks within the portfolio. We are bottom-up stock pickers, fundamental analysis of the companies, and tend to stay long-term investors. And this kind of, in a way, answers your question about that people have not made money in India. The key to that is to be with managers or be an investor for a longer period of time, ride out the short-term market volatility that you are currently experiencing. And if you are invested in the right kind of companies over a long period of time, you tend to make pretty good returns. So this is our, for the Mauritius fund, the returns for the Mauritius fund since inception. And as you can see, annualized, we have generated 9.4% returns compared to a market return. If you were in one of the ETFs or something that followed MSCI India, you would not have made money on an annualized basis in India. So if you kind of stay with the right managers, right kind of companies, and stay invested for the long term, that's when you tend to make money in India. Easier said than done, but it is the discipline that we kind of carry when we are investing in our portfolio companies, when we are analyzing companies, because we tend to look for companies that have the ability to wither and survive through the business cycles, come out of them stronger, and hence tend to generate that long-term returns that creates long-term wealth for investors. As you've said, that most of the participants are aware of India and the long-term story, the structural story in India. So what I'll try and do is kind of just take us through the current market scenario, where we are in terms of the economy with the current pandemic crisis, and how does that affect the structural story of India in any which ways, if at all. As you would know that India went into this crisis, or when the global pandemic hit us, India was just kind of starting to stabilize after a little bit of slowdown in the economy. We had gone through the crisis of ILFS, we had gone through the crisis of Yes Bank. The Indian banking system was not in the best of health. But as you were kind of coming out of it, the system was kind of stabilizing. You were hit with this pandemic crisis. India went into one of the most severe lockdowns that we have seen in the world. For about 2 months, the economy was virtually shut down. And that kind of created a lot of uncertainty. That is why India, for the first time in about 40 years, will see a GDP that will shrink. India has not witnessed this in the last 40 years. Obviously, this is going to have ramifications on corporate profitability. It's going to have ramifications on the wages, on the income growth. And that's something that's going to deal with. India will deal with. On top of that, you have the simmering India-China tension, and globally, the tension that's happening between US and China, and the global slowdown. And everywhere that you look, you see a lot of negativity. But that still doesn't derail from the structural trends that India is witnessing. If anything, there are certain structural trends which get accelerated because of the current slowdown. And some of the companies and the kind of companies that we actually seek for and are invested in tend to come out of this much, much stronger and much higher growth rates for as you come out of the crisis. So when we look around, we are quite excited by some of the opportunities that we see. Obviously, there is a lot of uncertainty. Things can kind of change and are changing at a daily basis. India is still witnessing in a record number of COVID cases. In absolute numbers, it looks very big when you're crossing 1 million. But if you kind of put it in context of the overall population of India, that number is not something which is out of averages with the rest of the world. So all in all, India seems to be weathering through this, is weathering the crisis much, much better than I think the earlier expectations were. As India has kind of emerged out of the lockdown over the last month and a half, we are seeing some encouraging signs on the economy. If you look at some of the high frequency numbers in terms of customs duty data or in terms of electricity consumption, these are showing an encouraging pickup to pre-COVID levels or slightly lower than that. Obviously, some of that is pent-up demand, but all in, we are still finding that a positive thing. And it seems that the economy is holding up much better than I think the earlier expectations. The same is the corporate commentary that's coming out of the current quarterly numbers or quarterly results that are being declared. And that again kind of points us that we are quite comfortable in the way the economy is kind of shaping up. So the long-term structural trends remain intact. What's encouraging is the unemployment data, which peaked out at about 23%, is now in the low double digits or high single digits. Structurally, India has seen in the past about 6-7% unemployment, and the participation rate is increasing as well. So it means that the economy is kind of remaining stable and the jobs are starting to come back, and hence consumption demand will start to improve as we go forward. The rural economy is shaping up much better than the urban economy. A couple of reasons behind that. One is that the Indian government, the fiscal packages that came out, although they were lower as compared to what you saw from the rest of the world, were very much targeted to make sure that the bottom of the pyramid survived. A lot of it went towards the farmers, and hence the rural economy, which is one of the biggest contributors to the Indian economy, has shaped up quite well, is stable. On top of that, monsoon is coming out, is quite normal for this year. Not just that, it's the distribution of the monsoon across the country, which is quite stable, and hence the initial sowing of crops is much better. So we have already sowed about 30% of the crops that need to be sowed for the season. On top of that, the minimum support prices have been raised. That means there is more money in the hands of the rural consumers. Similarly, the farmers are, in terms of when you see the numbers coming out for the tractors, farm agri equipment, as well as the added money that's gone towards the rural unemployment or the NREGA scheme. That means that the rural economy is shaping up well. The same thing is coming out in terms of corporate commentary. Something like a Britannia is saying that they are seeing not just urban but rural demand for their products increasing. Two-wheeler sales are picking up, especially in the rural areas. So the rural economy is kind of stabilizing, and that's quite encouraging for us. When you look at it on the urban side, as the lockdown has eased out, you have seen demand for some not just consumer staples, but consumer discretionaries, something like deos, something like your skincare products are starting to pick up as you kind of go through. Some of the high value tickets are still not there yet, but there is slow and steady activity which is kind of creeping up. And that keeps us encouraging that the economy is kind of holding up much better than there were earlier expectations or what people were expecting. If you look at some of the finance companies, some of the banks or the non-banking financial companies which have announced current corporate numbers, corporate results in the quarter, what you see is that the loans in the moratorium has actually fallen back. Okay, different companies and different banks are kind of putting it in different ways, so there is no similarity. But that's encouraging that the loans and the moratorium are coming back. All these banks and NBFCs have actually raised their provisioning, which has affected their bottom line. But the kind of companies that we are focused on, something like a Kotak Mahindra Bank or a Bajaj Finance, in the past have raised money. Kotak Mahindra Bank actually raised capital in the month of June during the crisis. So all these are very encouraging signs for the system as a whole. ICICI Bank, Axis Bank are looking to raise money. HDFC Bank is looking to raise money. And what this kind of tells you is that the RBI, which did a lot of the heavy lifting in terms of the initial response to the crisis, has removed that systemic risk that was there to the Indian banking system. And that risk has kind of removed. The funding or the cost of funding for the NBFCs, because of all the steps taken by the government and the RBI, have actually come down. And that's again encouraging as credit kind of starts to flow and prevents some of the bankruptcies that were immediately expected. We'll go through the next 6 to 9 months, and it's obvious that you will have an uptick in the NPAs. But this period has given banks and NBFCs to kind of shore up their balance sheets. Hopefully, we'll be able to raise enough capital. And hence there will be a certain section of the banks and the NBFCs which will come out of this much, much stronger. Obviously, the weaker players will get marginalized. You saw what happened to Yes Bank with the follow-on offering that they did, was not fully subscribed because that brand is tainted in any which way. But they were still able to raise a decent amount of capital, and that again is good for the system as a whole. And that leads us to believe that over a long term, the structural trend still remains intact. Um, you will have the public sector banks won't have any growth capital. The government doesn't have enough capital to push in. There is talks of finally again a consolidation within that and the government getting out of it, which will eventually happen. But as you know, about 70% of assets are with the public sector banks, which will move towards the private sector over a period of time. That shift had been slow, but we believe will accelerate once we go through this crisis and come out of it, because it's the private sector banks or HDFCs or Kotak Mahindras, uh, which will be the beneficiaries of this. Uh, at, Along with that, the bank accounts that under the Jan Dhan Yojana with the government opened gives these banks an avenue to push forward a lot of services and products to the consumers or over a period of time. So that kind of lays the groundwork for long-term structural growth. Insurance is one area which we feel is going to be a massive beneficiary out of it. India, anyways, was low in terms of penetration of insurance, with about 1% penetration, compared to say 1.8% if you look at Asia or 2.8% globally. India is not going to go to those levels in a hurry, but that trend will now accelerate because people have gone through a crisis, which means that insurance is something that they'll be looking at. So insurance is a long-term structural trend that we feel India will benefit out of. Similarly, on the demand side, if you look at your consumption, the pattern of consumption is currently from the staples, but as the wages increase over a period of time, as the per capita incomes increase over a period of time, that consumption will be aspirational in nature, will move towards premiumization. India is one of the youngest populations, so you will continue to see that structural trend kind of playing out. It's just that the avenue will change. Before the pandemic, the modern trade was the fastest growing section or category or area in India. That shift has now moved towards something like an e-commerce. And I think that will accelerate over a period of time because now people are more comfortable. In certain cases, have been forced to use e-commerce because there were no other avenues. So that structural change will kind of continue. But the consumption for the products, the consumption for biscuits, the consumption for your consumer discretionaries over a period of time will continue to kind of tick along. And that's where we feel there are a lot of areas to grow as the kind of economy comes out of this and again resumes that structural growth path. Obviously, infrastructure is going to be something that the government will focus on in the short term because that's one lever where they can kind of pull to revive the economy, revive demand. While we are not directly invested in some of the building material companies, what we prefer is something like a cement company where it's more of within the areas or within regions, there are specific players. It's a more of a oligopolistic, monopolistic kind of industry where it's easier to maintain prices. We are seeing that currently as well, where demand is not come back as quickly, but the prices are still holding up. With commodity prices going down, again, they are able to kind of maintain the margins within that. So earnings growth, even within the cement sector, will kind of continue to hold better than what you would see in some of the other sectors. So we have kind of exposure towards that, and we kind of continue to see those kind of growths coming through as the economy, not necessarily a V-shaped recovery, but a slow recovery over the next 6 to 9 months. So I'll just stop there and see if there's anything that any questions around that.
Yeah, I was going to, Gaurav, I was going to ask. Yeah. Actually, we have one question from the participant on your previous slide. Can you just go back one slide?
Sure.
No, yeah, this one. So basically now, you have obviously outperformed. So one of the questions was that, is it like when you're looking at the benchmarks, is it total returns? Because obviously yours is total return profile. So are the benchmarks also based on total returns, i.e. including dividends or not? This is from one of our participants.
No, it's not total returns, but I will also caveat that ours is net on a net basis. The returns that are generated for us is net basis. So this is for the retail fee share class of 2.5%.
Okay.
So, so yeah, so it's although it's not a total return, the benchmark that's being compared to, but then again, our returns are net of all fees, and we don't use any kind of hedging. So this is net US dollar returns after all currency fluctuations as well.
Okay, that's
Yeah.
good. One of the questions which I know some of our people will have, most of the audience, if you look at like sector specific, most of the people in our investor base are interested in like 2 or 3 different market in sectors. One is obviously technology,
Yeah.
one is healthcare,
Mhm.
and you refer to e-commerce in the thing, and that that
Yeah.
a lot of things are moving from the traditional ways of distribution into new ways of distribution. Now when I go into India, how do I get exposure? Are you looking at that healthcare, technology, innovation, all those kind of things? Is that something which you're able to capture or not really?
See, in a listed space, unfortunately, India has very few avenues of capturing those kind of companies. And I think that's a function of a couple of things. If you see the way the world has behaved over the last, I think, 10 odd years, where the cost of capital was very low, uh, a lot of these companies have been able to find funding which has allowed them to remain private. So something like a Paytm has remained private. So you don't have the Silicon Valley, you don't have those kind of companies in the listed space. I think secondly, where India is a little different is that India has been more open to global competitors, your Facebook, your Google, your Microsoft of the world, as say compared to China, which has its own Alibaba, Tencent. So, a couple of reasons why India doesn't have that investable space on the on the public equity side for some of these technology companies. But last 2 3 months have kind of created a way for consumers or way for investors to play that theme. Where Reliance is quickly turning out to be that all-in-one. It's a Netflix where they have a little bit of content. They have the retail, so a bit of the Amazon part of it. They have the telecom, a space which we certainly like now after all the consolidation and the ARPU is kind of moving up. It's becoming a 3-player market with a very distant third player. So Reliance is the best way to play it in a sustainable manner over the future. There are a few other companies, and I do feel that as you go through over the next 2 3 years, you will have some very interesting companies kind of starting to get listed, which will provide investors a way to kind of play the Indian technologies aspect. On the pharma side, we find opportunities, but we are still focused on some of the domestic names which are more domestic focused, where the optionality on the future value is from the international side. So something like a Torrent Pharma, which is into chronic diseases, but more focused on the domestic side, where they have the majority of the revenues. Their business in US, Germany is depressed at the moment because of the pricing on the generic side of the business. But again, that's an optional value play where if that clicks, that is added advantage for us. But the returns that they generate just of the India business is quite high. They're one of the highest in terms of margins, in terms of revenues earned per medical representative. And similarly, something like a DVs, where they have the ability to maintain high margins because of the kind of products that they do and the kind of APIs that they do, the kind of R&D that they invest in, and have a sustainable advantage. So these are the two companies which we are there in our portfolio, which we find will give us that long runway for growth in the future.
Okay. Okay. So I would say, so Ask is basically a play on the high growth potential of the traditional sector in India. Is that right? So, because your next slide also, maybe we can go to your next slide, the one which you just presented. No, so the previous one, sorry. Yeah. So in the current environment, with India recovering, maybe not a V shape, but like recovering strongly, would I be correct to say that you're basically offering an opportunity to participate in some of that recovery in the stronger companies that you have identified in the traditional space, right?
That is true. That is true. So we have always looked for a sustainable advantage, that predictability of earnings, the sustainability of earnings. One of our longest held companies, for example, is Asian Paints, right? And a sector which is in certain senses very traditional or slow growing, you would think. But over the last 10 years, if you look at that earnings, the company has delivered a compounded earnings growth of 18 to 20%. And that is across business cycles, across variability in commodity prices. And we feel once India goes through this current crisis, and it won't change that structural story in India, and that sustainability of earnings will come through. So, and what happens usually is when you go through a business crisis or a business cycle or a crisis like this, uh, the weaker players get marginalized. Something like, say, finance, for example. The cost of funding has gone up for all banks, all NBFCs, but it will go up much lower. The level will be much lower for for your HDFC, for your Kotak Mahindra Bank, as compared to, say, something like some of the weaker ones here, like a Yes Bank. And that gives them that sustained competitive advantage to build up on that. Similarly, because of the efficiency of the management, efficiency of the business, they will be able to manage their NPAs at a much better level. They have already, in many cases, raised capital, so they have enough buffer in terms of capital to go out and capture the growth once it starts coming back to the market. Whereas something like your PSU banks, except for say an SBI, they are so much constrained on capital itself that they will not be able to go out and capture any growth because they're just managing their NPAs. And that gives these kind of banks, these kind of companies, a long sustained advantage to grow in. And what you will probably see coming out of this is that the growth rates will accelerate for these kind of companies. And people talk of valuation, that what about valuation? But that valuation will actually increase for these companies because there's that sustainability of earnings, a higher level of earnings in the near future, which will help them grow much faster than the sector and the economy as a whole.
Okay. Okay. One more thing. One of the things, most of our investors are global investors. So obviously they look at relative value plays between, developed markets, emerging markets, between China, between India. I don't know whether, you've looked at it, but, of course, one reason why people want to be in India is for diversification, because ultimately it is going to be a very significant, large consumption market in the future just because of population. How do you think on a relative basis, if people are going to look at how much of capital they should allocate within the equity space between emerging, developed? Do you have any views on that, or that's not some topic there?
No. So see, like I said, India, when the pandemic hit us, India was anyways just kind of stabilizing in terms of an economy after the slowdown and the kind of crisis that went through in the financial space. And hence India actually, and there was the view that India will not be able to manage the crisis and it will be very bad for India. So when markets fell, India fell more than, say, the US or the China. India went into a lockdown, came out of it a bit later than what happened in US and China. Obviously, China was the first; it led in terms of number of cases going into a lockdown, coming out of it. But so India is a little one step behind in that sense. When the markets bounce back, India has bounced back as well. I think it's up about 45-50% since the lows on 23rd of March. But it's still less than what China or the US has done. Going forward, I think this will change on a relative basis. Simply for these reasons is why India will start outperforming the global markets and China. Because the Indian economy is on the way back, while you are seeing the second lockdowns coming through in something like US and China. You have the tension that's just starting to play out again between US and China, which will be a cause of concern. But because India has not gone up as much as some of the other markets, because the Indian economy is still kind of recovering, India is a little bit more insulated in terms of the world economy. So India will start outperforming on a relative basis is the feeling that I have in the near future. In terms of capital allocation as to what percentage of it, that depends on an individual's kind of personal. But India should be, I feel, a long-term something that you would kind of invest in, either in a lump sum or a systematic basis, and kind of keep it because that's something that will grow over a long period of time. Obviously, all markets have those changes. All markets have those cycles. So it depends on when you enter. But as our performance shows, um, if you kind of remain invested over a period of time, that's where you kind of generate the returns, steady returns. There will be variabilities in between, but because of the way we kind of invest in, and that's I think what gives us that comfort is when you're looking to invest with a capital preservation point of view, and that's not by taking an active cash call, but by kind of investing in companies that will sustain, will go through the crisis and come out of it stronger. And that's what kind of has allowed us to deliver this kind of returns. And we don't feel the future is going to be any different.
Yeah, sure. Thanks for that. The other thing is, then we have some global investors, but we also have some Indian investors.
Yeah.
And the Indian investors want to know how to differentiate, because obviously you have an onshore domestic presence also, and then this is an international fund. If they have to allocate, how would you distinguish between, would they allocate in rupees because they do have access and probably have some money onshore and they probably have some money offshore? Is there one better than the other, or how do you compare the two? Just because there is a question on that topic also.
Yeah, I think the way you would want to look at it is in terms of what regulations suit you best. What is best for you in terms of the way you want to manage your money, because I think if they are say investing through you, it's like very easy. You don't have the regulations are very clean here, right? In India, there have been changes in regulation in the past. Um, some of them for the better. Some of them are kind of making it a little tricky, and you know that when things are when government is looking for revenue, it's kind of going to start questioning every small thing. So it depends on what kind of systems that you have in place. If you have the kind of the way you are looking at, and in terms of what kind of money you have. So if it is onshore money that you cannot bring outside, then obviously it makes sense to keep being invested within India itself. And there are plenty of avenues to do that as well.
Right. And for offshore money, because of clarity of regulations, you think it's better to go through the offshore fund rather than doing the conversion and all that kind of,
Yeah. So if you're also looking at your returns in terms of US dollars or in a global currency, then it's easier to allocate money from your global, because then you are not, you invest in US dollars, your returns are every day seen in US dollars.
Yeah.
You don't have to do all those conversions, you don't have to do anything. And long-term basis, Indian rupee depreciates 2 or 3.
Yeah, that's the other question.
Yeah.
One, we've got a question. Rupee depreciation has eaten into the returns over the last 10 years. And how much return would one expect on Indian investments to outperform returns on the US side? So yeah, what's your view on the dollar rupee, etc.?
See, there are short-term bouts of volatility in the rupee, and that again goes back to the capital flow. It goes back to the way the economy is. But like I said, over a long period, and that's what you should be looking at when you're doing an equity investment in India, 2 to 3% is a long-term depreciation per annum that we see just because of interest rate differentials and inflation differentials. So the returns that we have are kind of after all that depreciation, because we don't hedge out the currency risk. It is part of it. but going forward, I think the volatility in Indian rupee might actually be lower. India is a net importer of oil. Oil prices are low. With a slowing economy, your imports are lower, and hence there is that less demand for your for US for US dollars, and net outflow is less. And as a result, I think the currency will kind of remain stable. What has actually happened is over the last month or so, the RBI has actually not intervened and actually been buying the dollars. So they have kind of built up their
Because of
watches.
reliance, I suppose.
Because of reliance as well, yeah. So that's the FDI side of it. But even in terms of FIIs, we have seen about 2.7 billion dollars of inflows. After the currency had hit about 75, 76, and that's where the currency has remained stable. So in that sense, the RBI is kind of creating a war chest for the future volatility that you might see in global economies. But that's again kind of kept the currency from appreciating and gives the RBI a little bit of more firepower to keep the currency stable if things turn bad in the near future. But on the whole, I would still build in like a 2-3% differential over a long period of time in terms of Indian currency depreciation in any kind of scenario that I would do.
Okay. Do you want to cover? I mean, we have the data on the specific funds on our platform itself, so people can look at that. But do you want to cover about the fund specific about the fee structure or anything, or let people just go to the?
Yeah, I think the way I think the way you have it is this is like I said, this is for the Mauritius. In Singapore, we have a 2% share class that is there, which you guys have onboarded on which is available through Kristal. And it's a unit trust structure in Singapore. We have our own FPI license. Our trustees, our fund administrators are BNP Paribas. The fund is audited on a regular basis by PwC Singapore. So we have the global service providers and global people, kind of custodians and everything. So it's pretty much a very simple structure regulated by MAS, and pretty clean and simple. We don't do any of the fancy stuff. We go in very boring, find 20 odd companies that we really like, tend to stay invested with them unless there is a change in a structural manner or we find better opportunities. We look for high earnings growth, where usually our portfolios historically and in the future we expect them to deliver, barring this year, obviously, about 20% per annum kind of earnings growth. It's not difficult to find those kind of companies in India. But I think what we do differently is, again, be very disciplined in our approach. We don't generally you won't find us in a lot of mid-cap space. We are generally tend to remain on the higher side of it. A very liquid profile as well, in terms of liquidity of the overall portfolio. Even the Singapore fund is a daily dealing fund, so you can kind of you have that flexibility as an investor to come in and go out as it you feel like it. So I think that pretty much covers it, unless there's something specific that you would want me to touch upon.
No, I think I think just want this is your broad overview. Otherwise, the details are available, and they can contact the relationship manager in Kristal, and we can give further details of exactly how everything works. I think that's been a great presentation. I think thank you very much. We're kind of reaching the end of our time. I see one last question. Let me just see if there's anything. Yeah, there's a question on whether the same thing about themes. Do you offer any multiple themes? Because obviously a lot of our investors are actually interested in themes, but I think yours, as you correctly pointed out, is a play on the high growth companies in the traditional sectors of India. So it's a play on the Indian economy. It's a play on the on some of the companies with moats around them who are able to generate sustainable revenue. So not really. So it's one fund that we're looking at, not sector specific or theme specific like we see in many other countries. So
this is more of a long-term India structural play, which will kind of go through any kind of market volatility. with ups and downs, but over a long period will kind of deliver the return.
Okay, that's a good thought to end on. Thank you very much. Barbara, anything from our side?
No, that's it. Thank you everyone for joining us, and thank you so much, Gaurav, for joining us.
Great. Thank you so much.
Thank you.